Good morning, all. Thank you for joining. We'll wait 2-3 minutes more so that few more people can join. Then we can start the webinar. Good morning, all. Thank you for joining for today's webinar, Knowing Your Potential. So we have been doing financial planning webinars for almost 2 years plus now. But this is one of the important questions that it's like, even if it is a early beginner, or let's say who started just working, or let's say who are close to the retirement can ask out. It's like, are we utilizing most of our, let's say, finances and making most of the potential as of now? So it's like this webinar is what we have created where we are going to answer and let's say ask more about how truly we know what is our financial potential and how most of us can make most of it. So to start with, so do you truly know your financial potential? Many of us get stuck in patterns of thinking small, let's say limiting our vision of what we can achieve financially, let's say timing the market and much more. We may underestimate our ability to build wealth, plan for our future goals, and or even retire early. But the truth is, financial success isn't about just numbers. It's about recognizing your inner potential and aligning it with your smart financial planning or smart planning. So once you understand your financial capabilities, your mindset completely shifts. So you're focused more on the personal and career growth, and wealth naturally follows as the byproduct of that progress. So our goal today is to help you uncover the potential and break past the limiting beliefs and equip you with the strategies to turn your ambitions into reality. So financial planning is actually not just about where you are right now. It's about where you can go from current position, and let's explore how we can unlock that further. So one thing would be, it's like why talk about wealth creation? So wealth creation is just not a marathon. So it's actually beyond that. It's not a sprint. It takes time, persistence, and a clear vision needs, let's say, a proper planning. So one thing would be quick wins may feel good, or let's say delayed gratification, as you all say. But true wealth compounds over years, not actually just over a period of days or weeks. So creating wealth isn't just about accumulating money. It's about understanding your current potential. And let's say, for example, if I have 100 rupees, and let's say even after meeting my end-to-end commitments and goals, how can I it's like make the most of it is the true question. So that is about it. It's like one thing is because wealth creation is not just about earning more or compounding the money, it's about realizing your full potential again. So money is a tool, but the main idea about is having the right mindset and the strategy behind it. So that's what truly changes a life. So most of us underestimate that we can achieve this financially. Let's say, for example, having a $1 million portfolio in India and so on, because we get stuck in a lot of patterns. And then it's like we invest a little, or let's say invest very let's say cautiously. So the key is to set a vision, think bigger, create a strategy, and start taking a practical approach, consistent steps to grow your wealth over a period of time. Because the sooner you start, the more your future self will be thankful for you. So that would be about it's like the main agenda about talking about the wealth creation part. So one thing is, it's like the key is like while charting your financial growth path, it's not just about financially, it's about holistic approach. Think of it as you're creating a roadmap for your future self for 8 or 10 years ahead. The key is the alignment. Align your vision with your income. Let's say, as we say, aligning your financial goal with your investments and so on. So one thing is, once your goals and your financial strategy or your investments are in sync, the progress becomes inevitable. So, but here's the catch. Growth isn't just a one-time event. It's a continuous cycle. When you hit a milestone, celebrate it. Just don't stop. Raise the bar, redefine your vision. What's the next version of success for you? So let's say, for example, let's say a person is starting at the age of 24. For him, the first milestone would be, let's say, 5 lakhs. The next would be 10 lakhs, 20, 50, 1 crore, and so on. And with each milestones, you can align it towards your financial goals. That's the idea about charting your own growth path. So one idea is stay consistent, and most importantly, keep asking from here to where can I go? And let's just scale up your position or net worth or asset allocation. So setting milestones and regularly rebalancing, it helps you stay on track. And once you start recognizing the patterns, growth becomes a way of life. And it's not just a goal or let's say a milestone that you would set for yourself. So one thing is, let's break down the core of the wealth creation. It's easy to feel overwhelmed thinking wealth is some, let's say, a mystery, but the truth is wealth isn't magic. It's a basic math. So ask yourself, why isn't wealth being created at your end? More often than not, it's because we misunderstand the numbers. People create shortcuts, take risky bets, or jump onto one idea to another, hoping to strike a gold. But wealth building requires understanding and the proper formula or a strategy behind it. Income, expenses, savings, investment, compounding. Let's say, for example, keeping your savings potential, cash flow, reducing your debt, and everything. It might, let's say, look very basic, but it's the main engines of your financial planning, or let's say engines of your wealth creation story. So when do you get this math right, wealth becomes very predictable. So the real question is, are you ready to embrace the numbers and let them guide you towards your financial decisions? So it's like, we'll take an example. So suppose, for example, we fall in not for, let's say, differences between traditional assets, financial assets, and so on, right? So even 1% matters, and that makes a significant difference over a long period of compounding. So for example, a person has, let's say, 100 rupees, let's say as of 2024, 2025, as of today. After 20 years, that is at 2044, at different rates of 5, 6, and 7%, the 100 rupees at 5% would be 265, at 6% it would be 320, and at 7%, 387. So just it's like assume this as a bigger number, or let's say with a monthly SIP, or let's say continuous contributions and so on. So that 1% also makes a huge difference in your entire wealth creation story. So hence, one thing that generally we miss out on while we do investments is, let's say, for example, we have a goal of, let's say, children's education, retirement, marriage, or whatever it is. In that, the main thing that we miss out on is the inflation. Because traditionally, it's like what we have seen is, let's say, for example, from our households also, from our family also, let's say if children's education goal is there, FD is being mapped to that goal. But if you actually consider the inflation numbers, it's too high for an education goal in India. Let's say 10 to 11% plus. Whereas FD, it would be post, let's say taxation and everything, it would be in the range of 6%, 6.5%, so on. There are other products also like PPF that are attractive considering tax rates and so on. So we need to have a very holistic approach, see what is our financial goal, make sure it's like whatever the amount that we need after 10, 20 years, we are inflation adjusting it, then map our investments towards that. So with this exercise, we just wanted to show like how 1% makes a difference. So we have one more interesting case study. So let's say, for example, a person started at the age of 30. And let's say, for example, 1 lakh per month as an SIP is what they could do the best. So let's say, for example, we have 4 options to compare. So one is value at the age of 65 years if she continued with the investments plan for, let's say, 1 lakh per month for next 35 years. That is, let's say, till 65. Second option would be value at the age of 65 years when she withdraws the corpus at the age of 40 and continues investing 1 lakh per month for the next 25 years. So let's say, for example, whatever corpus that you have built till 40, you would withdraw that, again, then contribute 1 lakh per month for next 25 years. Third option is value at the age of 65 years when she withdraws the corpus at the age of 40 years, and if she increases the monthly investment by 50% to 1.5 lakhs per month for next 25 years. Same as the case of second option, but here rather than 1 lakh as a per month SIP or commitment, she was doing 1.5 lakhs. And the fourth would be value at the age of 65 years if new investment not made after the age of 40. So let's say for next 10 years, or let's say 10 years exactly, until 40, you contribute and monthly SIP. After 40, you just don't touch it. So let's see what the growth would look like actually. So in option one, that is, let's say, for example, if the SIP of 1 lakh is continued till 65, the corpus that the person would have built is around about 65 crores. Option two, where the corpus was, let's say, for example, contributed till 40, whatever it was built, it was fully withdrawn, and then only 1 lakh as an SIP was continuously done. In that case, it would be 19 crores. In the case of option three, where let's say, for example, till 40, that is next 10 years, 1 lakh SIP was done. After that, let's say, for example, the contributions were withdrawn fully and a 1.5 lakh SIP was reinvested. In that case, the corpus would be in the case of 29 crores and so on. And in option four, that also looks attractive. Let's say, for example, for next 10 years, I did 1 lakh SIP. After that 40, for next 25 years, I just let it compound. In that case, it would have been 40 crores and so on. So this is what we wanted to show. It's like how big difference it makes. Because today's scenario, what we currently see is, let's say, for example, we are very comfortable doing a monthly EMI for a home loan for next 15 to 20 years or 25 years. But consistently in an SIP or a mutual fund investment, or let's say any equity investment for our financial goals is what we actually are missing out on. So if that commitment and that proper balance comes in the investments also, that would be a huge game changer for our wealth creation journey. So this is just for an exercise and for your reference purposes. Okay, next would be more about the milestones, or let's say wealth corpus. Let's say, for example, for ease of tracking, we'll take a higher number of 1 crore. One thing would be, let's say we are comparing at a three different scenarios, that is 12%, 15%, and 18% growth story. Let's say, for example, your initial corpus is 1 crore. It requires at least, let's say, more than 4 years to double the money. Let's say to go to 2 crores. After that, let's say, for example, the game of doubling actually would be more easier for you. Let's say, for example, after that, the subsequent doubling from 2 crores to 4 crores only takes 2 years. Post which, as you see, let's say in 12% growth, from year 7 onwards, the 1 crore is easily added and it's like much more. So one thing would be consistent compounding is what you need to focus on, and the discipline to stick with your financial investments. And let's say higher the growth rate, it's going to be beneficial for us. But yeah, 12, 15, 18% are, let's say, for example, a fair assumption to think about. So there is something interesting that I just wanted to add is about rule of 72. So let's say, for example, what rule of 72 means is, let's say how long investment takes to double. Let's say, for example, you are doing an investment in an FD and you're getting 6%, let's say, post tax. Let's say 6 divided by 72 is 12. So if you're putting 100 rupees, it takes 12 years to, let's say, double it to 200 at the rate of FD. Let's say, for example, same thing I'm doing at, let's say, at an equity investment of 12% and so on. So similarly, it would just take, let's say, 5 to 6 years approximately to double your amount. So that is the more idea about, let's say, doubling, or let's say a rule of 72. So this is also again for referring basis. Apart from that, one thing also just to add here is, here in this picture that you have seen, let's say I mentioned rule of 72, it would take 6 years to double. And you would have seen, let's say in 12%, we are doubling it at, let's say, 4 years itself. Here, because we have assumed a 20% yearly step up in, let's say, for example, on all the investments. Let's say if you're doing 100 rupees today, next year it would be, let's say, 20 rupees extra you'll add on to that portfolio. Assuming that, it's like the doubling would become more easier and quicker. That would be the idea of it. So rather than just making an investment and forgetting it out for next 20 years, 40 years, scaling it up at regular intervals is going to boost out your wealth creation journey. So that would be the idea about it. So moving out, financial planning, a need and a habit. So I would actually pass on to my colleague, Mr. Janakiraman, to continue from here.
Thank you, Vinayak. So till now we saw things about like how much to invest, what would you be your actual potential, and how to kind of realize it. Right now we look at the kind of engines that will get you to here, so that you can realize your potential and go far beyond it. Financial planning is where we start and where we end. As long as we have a plan in place, whatever your target might be becomes easier to achieve, and you have a set roadmap that by and large 99% of the time, if you do follow it, you'll get there. Of course, there'll be some variations to the plan. There may be some life changes that happens, but more than not, financial plan does help you get to your goals. Now, next slide. So let's talk about the basics a little bit. So because getting these few things will kind of help you get the 80% of the way. So just like the 80-20 rule, if you do 80% of the things, you'll get to kind of these 20% of the things will get you to the 80% of the results. First is, let's try to map out your budget. This does not have to be in something like an Excel or things like that. You can just take out your phone and map out your budget. Just three things: how much you earn, how much your expenses are, and how much you save. What you can start with your in hand, because that's what most people are familiar with. So if you're able to compute these three things, and if you think on a conservative scale, this is the savings that is going to be available with me, then we can move on to the next place, which is insurance. So basically, what insurance says is very simple. We only talk about two types of insurance here: health and term. We do have a lot of webinars covering these insurance in object detail, but for now, we just talk to you about these two things. If an investor has a good health insurance policy, in the case of a family, a good family floater policy of, let's say, 5 lakh per individual, or let's say a 20 lakh or 25 lakh family floater policy for a family of four, they should be okay. Just make sure that the health insurance does cover tick off most things. Term, if you're someone who does have a lot of dependence in place, maybe you do have home loans and things in place, your life is worth a lot more. So instead of going for money back policies or ULIP, I would highly suggest you go for things like uh, proper term insurance policy that will get you all the way. Third, and coming to the halfway point, we're looking at tax. Tax has been made very easy for people, I would say, going forward. Going forward, the updated new tax regime starting April 1, 2025 makes a lot of sense for a lot of people, even for people who earn a lot of money. The old tax regime only makes sense if you're able to claim each and every kind of deduction that it has to offer, including having a home loan in place. Plus, if you do have a relatively high HRA that you're going to claim, then I think old tax regime might come out slightly better. But for most people, the updated new tax regime is going to be the way forward. Fourth, we should look at your asset allocation and look at how your current asset allocation is tilted. Even in my own family, what I'm seeing is that the asset allocation is tilted more towards physical assets or real estate. So now the kind of job starts where you will kind of take these things and put it into diversify into things like maybe financial assets, some FDs, some PPF, maybe even things like cash balances, so that you have reserves and stuff in place. Fifth, managing your loans well. So people might have different kind of loans. These may be personal loans, credit card loans, home loans, car loans. So managing these becomes the utmost kind of priority. We look at a slide where we talk a little bit more on loans, but essentially there are good loans and bad loans. Good loans being your things like your home loans, maybe even something like an education loan that you can kind of take to upskill yourself. Bad loans are things like maybe loans that are taken on depreciating assets or most probably a personal loan. And lastly, if we can get these things in place, planning for your future. See, the planning for your future is going to be the part that is going to be different for most people, because your goals are going to be completely different from what me or Vinayak or anyone at ithought has. So that is where financial planning comes in, where crafting a personalized roadmap can help you get to your goals and your targets and run your race better. Because what we see a lot with our clients is most of them, before they came to us, they were looking at arbitrary timelines or arbitrary goals where they know they need to get to that goal. They know that this goal is important to them, but they didn't know, okay, how much to save for it, how much inflation to take forward, or things like what should I be investing towards, where should I be investing towards, how much should I be investing towards this goal, or should I look at this goal at a lesser priority item than some of my goals. So this is where financial planning can help you, because this is not a standard process. This will depend on an individual to individual basis. So this is when we can come and handhold you and kind of help you chart out your goals and roadmaps and start implementing action towards them. So if we can get the six of these things right, I think for 80% or 90% of the investors, they should be on track towards getting to their goals, which is what financial planning aims to do. Next slide, Vinayak. Now we talked about goals. Let's talk about how do we get there. So, creating wealth is what financial planning aims to do. So, if we can create sustainable wealth over a longer term period for you, I'm sure most of your goals will be met, and most of the goals we see are financial goals. So you can think of wealth as a plane. It doesn't fly with one engine. You need multiple engines to keep it moving, because in the case of an engine failure mid-air, you always have a second engine or a third engine or even a fourth engine in some of these jumbo jets that we see today to keep it moving. So that is where an engine of wealth comes in, where if you're an investor who had invested in certain risky assets like maybe small or mid-cap mutual funds, at a time like this when markets are going down, if all of your wealth or a substantial portion of your wealth is concentrated there, you'll see a momentary drop in value in your portfolios and even in your personal wealth, where they might have corrected close to 20 or 30%. So to kind of avoid those mistakes is where each goal will have certain assets mapped to it, and a multi-asset kind of approach is the best way to go for it. If we look at investments, you have things like mutual funds and mutual funds for different goals. If it is going to be a goal that is going to be 3 or 4 years, there are certain conservative mutual funds that we would like to go for. And if it is going to be a longer term goal, of course, certain kind of aggression can be taken. But as long as the investor is able to bear it and it is inside the framework of the investor. Because most people think that they can handle a lot more risk, but once that risk plans to pay out, you see a lot of volatility in the portfolio, and they are not able to digest that volatility, because volatility is not something that comes and goes. It stays, and it can stay for a long time, just like the pain that we are seeing going on in the small and mid cap space. Secondly, a PMS for people who do want a more customized approach, who do want a more curated approach, who do want a more a kind of a better framework towards risk management. A portfolio management service is something that works well. We do have a different set of products that cater to different set of investors and their goals. The minimum requirement is 50 lakhs as per SEBI regulation. But if you do have any questions, you reach out to on us. We'll be more than happy to help. Secondly, coming to your assets, most of your assets are going to be already here. These are going to be a real estate or fixed income instruments. So based on your goals and based on your requirements, some amount of diversification, some amount of risk taking might be required to get to your long-term goals. Thirdly, your savings. This can be goal-based savings or emergency funds. So emergency funds, plain and simple, I might be repeating this again and again, but having 6 to 8 months of your expenses in an emergency fund, in an FD, in an arbitrage fund, in a debt fund, is what is going to kind of help you tide over the volatility whenever you see a drop in your portfolio, and let's say you need some kind of an emergency money, because that is not the time to withdraw from the portfolio. That is actually the quite the opposite. That is the time to put more money in, or at least leave your investment as such. Goal based savings is very simple. If you have a goal of things like, saving for your children's education, or saving for, tuition fee or things like that, you start a monthly savings plan and you kind of put it into a conservative investment and you start saving towards it. So this is how holistically we look at engines of wealth. In a more detailed manner, we look at, each fund as being mapped towards a goal, or each product as being mapped towards a goal, or each kind of a land or a real estate asset or a fixed income instrument or a bond as being mapped towards a goal. That is where a little bit of minute tuning comes in, where it can help you reach the last mile. Moving on to the next slide, we'll be talking about understanding leverage. See, leverage is not inherently bad or good. Leverage is something, it's just that we have to understand it and use it at the time that is most appropriate to them. So, what is the kinds of leverage that we see today? The kind of leverage that we see today is mostly going to be personal loans, maybe some home loans, no cost EMIs, things like this is the kind of leverage that we see. So, when do you need to use leverage? So, when do you need to use leverage is maybe an asset where, let's say, a home where you made a 25-30% down payment and you're comfortable with taking the rest as a loan, because you think a 7 or 8% home loan is okay, where over the long term you'll be able to make maybe 10 or 12% on equity, where you'll have some alpha. So that is where a home loan makes a lot of sense. Now, coming to the next one, which loan does not make a sense? Another loan that makes a sense is an educational loan, because unlike an equity, where equity might give you 10 or 12 or 13 or 14, whatever that is, investing in yourselves can pay dividends like any other equity instrument that you've seen. This might be, going to study a course, investing in education abroad, things like this, where you might get a job offer with a 40% hike or a 50% hike, just like that, or a very good signing bonus. These are things where it makes a lot more sense, because very simple, investing in yourself can pay out dividends at a much larger value than any equity instrument can ever do. Uh, Now, look what kind of leverage that you should not be using. The kind of leverage that you should not be using is probably things like, any kind of personal loan. That is something that you should avoid, because especially if this is going to be for things like discretionary things like, buying a phone, buying expensive things, buying luxury items. So these are things that should be avoided, because these loans carry a very high rate of interest and you just end up paying a lot more in interest than it. One more loan that maybe you can avoid to some extent is a car or a vehicle loan, where sometimes this becomes mandatory to fulfill your job requirement. But what I would say is, in that case, try to take a loan with a higher down payment, or if you do take a car loan or a vehicle loan, try to finish it off in a 3-year span, so that the interest outgo is very less and you end up paying a lot more on principal only. So you can choose to use leverage strategically or not strategically, and you can choose to use leverage in a manner where it can have a very good impact or a negative impact on your future. This depends on the type of loan you take, and most of the things that we've seen is most of people take a loan out of kind of not even an emergency, kind of uh, an impulse purchase or an impulse buy, because credit is being offered out very easily, very cheaply in kind of 2 to 3 button clicks, but they kind of begin regretting it over a period of, let's say, 5, 6, 7 months, when a lot of EMI does go out of their pocket. So leverage is a tool, not a necessity. Use it strategically to grow your wealth without risking your financial stability, is what the ideal thing that this slide would want to say. Moving on to the next slide. Now, I'll quickly take you through the impact of taxation. So, most of you might feel this is unfair. To some extent, it is, but this is how tax structure is kind of framed. So, there's nothing much that we can do about it. So, if you look at salary, you'll have income tax out of it. So, whenever you get salary, TDS is automatically deducted, and your employer pays you the rest. Whenever you go and buy something, you pay GST. GST rates vary. You might be eating out and paying 5% GST, or you might be buying an AC or a TV and buying 18% GST. So that depends. Thirdly, you have capital gains. You have short-term capital gains at 20% and long-term capital gains at 12.5%. Now, the first two, I don't think we can do anything about it. But I do think this tax change that government have brought is going to have a very good impact on it. The second thing, there's not much we can do about it. GST is going to be there. There's not a lot we can do about it. But what we can do a lot about it is the third one, because anyway you're getting taxed at a, let's say if you're in the 15 or 20 or 30% bracket, you're getting taxed as a pretty high rate. Why put your investments in instruments that are going to have the same taxation? So let's say you have a goal of 5, 6 years away. Why put it in an FD which is going to have the interest taxed at 30%? Whereas since you have the goal tenure, why not put it in an equity mutual fund or a similar kind of a growth instrument which has long-term taxation at 12.5%? So basically what I'm trying to say is, you're already getting taxed. Make sure that the money that you receive in hand is going to get taxed at a lower rate in the future. Equity does have a lower taxation rate and also has an exemption limit. So these are special rates that apply, where just because you're taking a little bit more risk, government is willing to offer you a lower rate of taxation. So let's try to make use of it. Going to the next slide. Now, let's try to find a right balance. Because wealth just isn't about you put this much as SIP, this much as step up, this much as lump sum, and you'll get there. No, it's also about making certain wise decisions. These might not be very big decisions. These might be smaller decisions that you make over a period of time. Okay, let's look at how much should you set aside for your family support or healthcare. This is a very important question to have, because my family will be different from yours and yours will be different from mine. For example, you might have elderly parents. You might have like certain commitments in your brother or sister's side to take care of. So having a higher emergency reserve or having maybe 10, 15 lakhs in an FD does make sense for you, because that is your goal and that is the requirement that is. Should you buy that second car? Should you travel abroad every year? Now, this is an important question, because if you do have the wealth and if you are someone who's saving good amount of money, who's investing good amount of money, and if you have surplus left over, then I think these things make sense. If you do have a need for it and if you do want to do it, that is what life is there to do. That's a part of life that to enjoy the wealth that you create as well. But if you're someone who is not able to save a lot, if you're not able to invest a lot, and if you're looking at a future where this might continue, I think these are decisions where you'll have to think a little bit more before you do it. Uh, Thirdly is a decision that I think a lot of us should ask ourselves: can you maintain a high lifestyle while saving for a future? If the answer is yes, I think you are on a good track. You don't need to do a lot more. Yes, maybe you can improve it a little bit. But for people, if the answer is no, then I think saving and investment, at least for the next 4 or 5 years, should take priority, because whenever you invest in a market that is down or that is trending down, you look at future results that is going to be better. So take this as an opportunity to start building your wealth, so that in the future you have a bigger corpus to enjoy. Um, Now, a question that a lot of people do ask me is, should you buy a home in your native place as well? See, this is this is a very emotional decision to take, because you might be someone who would want to do that, but if you're not going to settle there, or if you're not going to go there, if you see yourself living in one of the cities for quite a long period of time, then I would see it does not make sense, because you do still have to maintain it, you do still have to pay property tax on it, you have all these things to also take care of. At the end, the decision is going to be yours, but you know, these things are where a financial plan can come into play to kind of help you. If you do already have a house, then I think it makes lesser sense to kind of buy one more. But again, this is where you might have the need for it, you might have the want for it, you might have a genuine desire for it. So that is where we will come and we can kind of help you do it. Going to the next slide. Uh, Now, for most of us, or for all of us, in fact, reflecting on our potential is very important, because most of us have achieved quite a lot over the span of whatever our lives might be. Now, how do you take it to the next level? How do you make sure that your potential is not only achieved but is surpassed? Is where a plan comes into play. A plan can kind of help you achieve that potential, because having big goals is what financial planning is all about. You having big goals is what we as financial planners want, because that's what excites us and that's what help us kind of push you towards getting towards the goals. This is where a vision is created, and once a vision is created, I think most people become very focused in their lives and start working towards it. Let's begin building your engines of wealth and managing your decisions wisely, because once you do it over a period of, let's say, 6 months, a year, a couple of years, this compounding becomes very, very evident and you start to see the fruits of it. Small steps today indeed will lead to a much bigger future in the end. And I think that is where a plan can kind of come in and help you realize that potential, because I'm sure all of us will get that. But how soon we can get that is, I think, where a plan can help you get that. I would just like to complete with a couple of quotes that are quite favorite to me. See, if whatever it is, whatever skill that you're learning, whatever, if you're trying to make money, whatever that might be, if from our end, there's only two things that needs to be done. You just have to be persistent and you just have to keep showing up. If you do these two things, and whatever new skill that might be, you would have heard about something called a U-shaped recovery. So U-shaped recovery is where, let's say, you start learning new things, or start saving, or start investing, or start making money. Usually the U-shaped thing is where investments will go down. When you start investing over a period of 1, 2, 3 years, you won't see much results. It will go down, but over the fourth, fifth, or sixth year, you will see a lot of these going up. So I think showing up and kind of making sure that we kind of put our own capital and our own kind of discipline month on month into investments kind of gets us there. And this is kind of true for all aspects of life, but even more true for investments, where you only get to see the process and the potential kind of play out over a 4, 5, 6 year period. But after that, I think investing kind of takes a much higher pace, where you see a lot more wealth being created in a much shorter place of time, because you've done the hard work for the initial years. Uh, Thank you. Please do post whatever questions that you have. We just wanted to kind of start this webinar before the financial year, because starting from the financial year, at least we would want people to kind of make good financial decisions and start putting more money into investments or saving or whatever that might be, and pushing them towards their goals. So please put your questions in the chat box. Me or Vinayak will be more than happy to answer them. And thank you guys so much for coming here on this lovely Saturday morning. And we'll keep conducting a lot more webinars like this in the future as well for your benefit. So you guys can put the questions in the chat box or on the FAQ page. We'll be more than happy to help you.
Hi, sir. So you mentioned where can we save the emergency fund? As of now, I put it in my savings account, but I'm not sure if it is fine or not. So correctly, sir. So one thing would be, let's say, for example, uh, I would recommend it's like you can think of something like an short-term debt mutual fund, arbitrage fund, or let's say even an FD. Because compared to savings account, what the problem is, let's say if it is in an FD or let's say a structured product like a short-term debt mutual fund, like taking it and spending it for unnecessary activities or let's say some discretionary spending would be on a higher end if it is in savings account because it's easily available and it's in the bank account. So it's easily withdrawable and transferred through UPI and so on. So emergency reserve is something for a contingency. So hence, if there's only the need to withdraw that, it's like it needs to be utilized. So hence, in that case, I would recommend you can consider having it in, let's say, any debt mutual funds or arbitrage funds, or let's say even in FDs. So if you already have been investing, it's like you can reach out to your advisor. They'll help you out in this game case. And apart from that, also, it's like one thing would be the rate of return that you would get. Let's say, for example, right now you're maintaining 6 months of your expenses in an emergency reserve. And in savings bank balance, if you just maintain it there, it might take, let's say, more than 3, 4 years to just move it or let's say double from there. Whereas in FD or let's say in a debt mutual fund, it's going to be more attractive compared the, let's say, whatever the growth rate should be. Let's say compared to a savings rate of 3%, it would be better in, let's say, in debt mutual fund and so on, which would be ideally 6 to 7% and so. So Mr. David asked, avenues for investing in current situation may be explained. Explain the strategy not to lose, especially in mutual fund. So one thing would be, sir, let's say, for example, there are plenty of avenues currently also in the market, but it's gonna again depend on, let's say, everyone's financial structure, their requirement, and their everyone's goals are going to be very dynamic. So it won't be one shoe fit for all. It's going to be very customized and personalized. Apart from that, it's like one thing that a strategy we need not to lose out on would be, let's say, right now market is at a very volatile phase and most of us has faced the drawdown or let's say volatility the market has given us. So at this times, we also come across a lot of questions. It's like, is it the right time to stop an SIP investment? Should you scale it up? And a lot of questions would come in. So one thing is, if you already have an advisor and if you're comfortable with the work, and let's say, for example, whatever you're investing in, you have good conviction for next 3 to 5 years and so on, I would recommend you can continue whatever investments that you're doing and so on. But let's say, for example, if you are not sure or you are still uncertain about it, you can get it reviewed from us too. And then we can help you stay on track and let's say review what is going to be best for you. And that according to that, we can see what investment avenue would be suitable for you. Nakul, there's a question on how to develop a strategy to rotate capital more efficiently.
Sure. Thank you. Um, See, sir, rotating capital is one thing, but identifying market circles is another thing. Let's say you have capital that is in a savings bank balance or in real estate, and you want to maybe move it to more financial instruments. I think rotating capital at a point like this makes a lot more kind of sense because you are at a market low. So putting more capital into kind of a market that is falling or that is consistently making loss makes a lot more sense. But one more thing is rotating capital will often not result in you getting the benefits of compounding. So if you think you have a goal of 7, 8 years, I think being invested and maybe adding more investments consistently to one asset class makes a more sense than rotating out of each because identifying the highs and lows is pretty hard and we never claim to do it. So maybe even more than rotating capital, I would say kind of consistently sticking with one avenue of investments for a longer period of time makes a lot more sense. Debt mutual fund gives around 7 to 8%, but investing directly in bonds give 9 to 12%. Taxation wise, which is ideal, bond does give frequent cash flow. So debt mutual fund also gives frequent cash flow. If you want the cash flow, you can withdraw. Even debt mutual fund is even lot more liquid than a bond because if you buy a bond, the capital is locked in for a 10 year, 5 year, 7 year, 8 year period. But let's say if you have a debt mutual fund, you can withdraw capital or interest or both or each individually whenever you want to do. Uh, Taxation wise, both debt mutual fund and bonds will be taxed. Their interest at least will be taxed at your slab rate, which might be 20%, 30%, or whichever tax bracket that you fall to. Yes, bonds will offer a slightly higher interest because these are individual positions. But please be careful because we are seeing a lot of defaults and we are seeing a lot of non-payment of interest also coming in. So does not make sense to go for bonds for 1 or 2% higher interest because if you want higher rate of return, you have equity as an asset class to do it. Debt as an asset class is never is never would be suitable to do it. So that is why we rather just suggest debt mutual funds or very very high quality bonds. But these high quality bonds will then just offer you interest on par with your debt funds. Whether the emergency fund can be invested in the mutual funds. Yes, 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 ma'am. You can put it in debt funds. It does make sense. You can park your emergency funds in debt funds or even arbitrage funds. Thanks. Can we continue even in small cap now? Which one would be apt now? Sir, no, sir. Small and mid cap as a sector, we've been consistently being negative on because these are funds where if you have more money, it makes sense to not put any more fresh money into it because it might take you for the cycle to kind of pan out over a long period of time. So we would just say from our end, the kind of recommendation is still not going towards it.
So also it's like, so you can share your portfolio with us, we'll review and let know. Because like considering your entry time in the market and your risk capacity, then we can give you more feedback on that. That would be ideal too.
If you guys do have any more questions, please post them in the chat. I think there's one more question. Uh, Term plus wealth creation plan like HDFC Simple Life Protect Plan. Is it good to take? No, so we usually suggest just taking a term plan plus just investing the balance premium in a mutual fund because that just works out well. If you do insurance plus investments, usually what we see is that the product is not good and the fund choice is also not good, and you just end up paying a lot more fees in place. So just take a plain simple term plan and take just a plain simple mutual fund where it will help you create wealth and this will create you protect yourself. Which one are you recommending at this juncture to get around 12%? So we don't give out any recommendations. If you do want to kind of invest along with us and to kind of help you invest, please get in touch with us. Vinayak has put the contact numbers in place. We are more than happy to help you. Please suggest bond instrument on you. Sir, please do get in touch with us from the above numbers. We'll be happy to help you with the bond suggestions as well. What about multi-asset funds? How much we can expect returns on? What is the time frame we have to invest in? So multi-asset funds are good. They are very good. But what we also like to do is we like to manage multi-asset in a portfolio structure as well, where we like to pick gold, silver as individual funds, debt as an individual product, equity as an individual product, and manage it because it gives us more control. How much returns? Usually we say 10 to 12 or 10 to 14% is good return target to have because you do have other asset classes in place which will reduce your volatility as well. What is the time frame we have to invest in it? Sir, any product that has equity in it have a 5-year time frame. That is a rule of thumb. Thanks so much for joining the webinar. It's been a pleasure having you guys. We do webinars every weekend as well, and we'll have more planning webinars and more kind of unique webinars like this, where we kind of talk about your potential, we talk about wealth creation and things like that coming your way. If you do have any questions, please get in contact with us through mail or phone. We'll be more than happy to help you guys. It's been a pleasure to have you guys as well as my co-presenter Vinayak here with me. We'll be looking forward to doing more of these in the future. Thank you.
Thank you all for joining the webinar.